Debt finance really is about any amount of money you borrow that has to be repaid. So it could be from a bank, it could be from one of your mates, it could be from a family member. But fundamentally the difference between debt and equity is that the debt needs to be repaid over time. It might be 1 year, it might be 30 years. Equity finance is where you put your own money into the business and you're prepared to invest that in there for the long term and achieve a return on that equity you've invested in your business. So the types of short-term business finance, really traditionally, there's been overdraft. Overdraft has traditionally been a bank-type facility made available to businesses, usually not without having security through property assets or other security. However, there's been a growth in the market to what we call working capital finance. Loosely termed, it's replacing overdraft. Working capital finance can be in the form of an overdraft, can be in the form of a short-term loan, less than 12 months. It's usually secured or unsecured. Secured means there's usually commercial or residential property backing it. Unsecured means it's against the business, or it's unsecured with a director's guarantee. So trade finance, what is it? It can be usually termed to be finance used to source plant equipment or inventory or materials for use in your business. They can be sourced from overseas or domestically, and the terms of that usually can range from 30 days up to 150 days. So for a lot of small to medium-sized businesses, it's a really positive way to secure those materials that you normally would have to pay cash for. There are lenders out there that will provide you terms, as I said, up to 150 days. Types of long-term finance, again, just to differentiate between long-term and short-term. Long-term, really anything from 1 year out. Many banks, particularly for trading businesses, small to medium-sized trading businesses, won't really extend terms beyond 10 years. But if you're looking to buy commercial premises or that type of asset, they may stretch it out to 15 to 25 years, and that eases your cash flow in making the payments through that term. By its very nature, it's a loan that you have an extended term to repay. It can extend usually from 3 to 10 years for most businesses. It means that you have to pay interest and also the principal back in that 10-year period. Term loans can be provided sometimes initially on an interest-only basis for a period of time to smooth out your cash flows, but ultimately the lender will want repayment over the long term, over the term of the facility, which, as I said before, usually can have up to 10 to 15 years. So asset finance, really what is it? It's really just long-term finance to purchase that new truck, that new work ute. It could be contemplating upgrading from old school energy to a new solar and battery installation. It could be upgrading that production line that's been breaking down a lot over the last 12 months. It's been costing a lot of money. Final thoughts relevant to a business owner in that small to medium sized space. Fundamental, you want to focus on running your business, working on your business to generate more sales revenue, keep your costs at a minimum to gain very strong cash flow on a monthly basis. That's where you're best placed to continue your endeavours. We work with you to research the best possible solution for that next stage of your business, whether it's a growth capital that you're seeking, or finance for a new factory, or finance for a new truck, or a range of assets that you might need in your business.